Every single revolution begins with a question, and tonight the question sounds almost absurdly simple. Where does money come from? Ask most people, and they'll probably imagine a printing press. The central bank decides. The economy needs more money. Fresh banknotes are created. But here is the strange part.
Most of the money we use every day was never printed. It doesn't exist as notes. It doesn't exist as coins. It exists as numbers inside
bank accounts. And much of that money entered existence through something almost everyone knows. Debt. Take out a mortgage. A bank can create a new deposit, repay that loan, and that money can effectively disappear again. Welcome to one of the least understood machines in the modern economy. The creation and destruction of money. Who actually creates money? I am Lord TokenWire, and today we follow the money.
Imagine you have £5,000 in your bank account. Where exactly is it? There isn't necessarily an envelope sitting inside a vault with your name written on it.
Your £5,000 is principally a record, a liability of your bank to you. The bank promises that you can transfer it, spend it, and that's how most modern money exists. Not as physical currency, but as bank deposits. We increasingly live in an economy where money is information. Your salary arrives electronically. Your rent leaves electronically. You buy groceries with a card. You pay for coffee with your phone.
Millions of pounds can move across financial networks without a single banknote changing hands. So if most money isn't physical, who creates it? This is where things become interesting. Imagine you want to buy a house. The price is £300,000. You approach a bank and apply for a mortgage. They examine your credit history,
The property, your ability to repay, and eventually, your loan is approved.
Now imagine the bank simply needed to find another customer with £300,000 sitting around and hand their money to you. That's an intuitive picture. But modern banking doesn't work quite that simply. When a commercial bank makes a new loan, it can simultaneously create a corresponding new deposit, a £300,000 loan, an asset for the bank because you owe that money.
On the other, a new deposit. Money available within the banking system. The loan and the deposit are created together. That means commercial banks span the quantity of deposit money in the economy.
A mortgage doesn't merely move existing money around. The lending process itself, and this is where one of the great misconceptions about banking begins to unravel.
You'll sometimes hear the dramatic phrase, banks create money out of thin air. There is a grain of truth buried inside it, but it's also misleading.
Banks cannot simply type any number they like into an account and become infinitely wealthy. When a bank creates a loan, it also creates an obligation. The borrower owes the bank owes the depositor.
And the entire process operates inside a heavily constrained financial system. Banks must consider capital requirements, liquidity, regulation,
Funding costs, credit risk, potential losses, and whether borrowers can actually repay their loans.
Banks also need access to central bank money to settle payments. Commercial banks can create deposit money. They do not possess an unlimited magic money machine.
Credit creation is powerful, but it comes with risk. And history has repeatedly demonstrated what happens when that risk is ignored.
Now another character enters our story. The central bank. In Britain, that's the Bank of England. They also influence the cost and availability of credit through monetary policy.
One of their most powerful tools
Is the interest rate. Raise rates, borrowing generally becomes more expensive, mortgages cost more, businesses may invest less, consumers may borrow less, credit creation can slow. Lower interest rates, and borrowing can become cheaper. Demand for credit may increase. Economic activity may accelerate. By changing a single interest rate, policymakers ripple waves through mortgages, businesses, and markets, influencing every household across the entire economy. Policymakers aren't controlling every pound directly. They're influencing the environment in which money and credit are created. Now comes perhaps the strangest part. Money can be created when banks lend.
But what happens when loans are repaid?
Imagine part of your mortgage principal is repaid. Your bank deposit decreases. At the same time, the outstanding loan on the bank's balance sheet decreases. Created through lending, destroyed through repayment. The deposit money is extinguished. Of course, interest is different. Interest becomes income to the bank and can subsequently be used to pay wages, expenses, dividends, and other costs.
Money isn't simply a fixed pile of tokens circulating forever. The supply of bank money can expand and contract.
Money is dynamic. Which leads us to the obvious question.
If money can be created, why can't we simply create unlimited amounts of it and make everyone rich? Because money is not the same thing as wealth. Imagine an island producing 1,000 loaves of bread. Now double everyone's money overnight. Have you doubled the amount of bread? No.
You've doubled the amount of money competing for the same goods. If spending power rises much faster than the economy's ability to produce goods and services, prices can rise. Inflation.
Real wealth comes from what an economy can produce. Homes, food, energy, medicine, technology.
Real wealth can produce infrastructure, skills, knowledge. Money helps us measure and exchange that value. But creating more units of money does not automatically create more real resources. That's the distinction that matters. And now we arrive at something deeper. Look at a banknote. It appears solid, permanent, real. Look at a number inside your banking app, and somehow it feels less tangible. Yet both depend on something surprisingly fragile: trust.
You trust your bank to honor your deposit. The bank trusts borrowers to repay loans. Businesses trust customers. Investors trust institutions.
And society trusts that pounds received today will still buy something tomorrow. Modern finance is therefore not merely a system of money.
It is an enormous network of promises. Break enough of those promises, and financial systems can begin to fracture.
That is why banking crises can become so dangerous. When trust disappears, money suddenly feels very different. And now, the machine is changing again. Artificial intelligence is entering finance. Algorithms already analyze credit risk.
And now, detect fraud, trade assets, process transactions, assess customers, and increasingly,
Help financial institutions decide who receives credit. That raises an entirely new generation of questions. What happens when machines become better at predicting who will repay a loan? Could credit become cheaper? Faster? More personalized? Perhaps, but another question follows.
what happens when an algorithm decides,
You are not understands that decision.
who challenges it, and who ensures the system remains fair?
For centuries, humans decided who received capital. Tomorrow, machines may increasingly participate in that decision. And because credit helps create money,
AI could eventually influence not merely how money moves, but where new purchasing power enters the economy. So, who creates money?
The answer isn't one institution. Central banks create central bank money and issue physical currency.
commercial banks create much of the deposit money used throughout the economy when they make loans. Governments influence the system. Governments influence the system through taxation, spending, borrowing, and regulation. And millions of borrowers participate whenever they take on credit and repay debt. Modern money is therefore not manufactured in one mysterious room. It emerges from an interconnected system of banks, governments, central banks, businesses, and people.
And beneath everything lies one fundamental ingredient: trust.
Money was once cattle, shells, silver, gold. Then it became paper.
money became plastic credit cards. Today, much of it is simply data, a number glowing on a screen.
But perhaps the most important thing about money hasn't changed at all. Behind every number, there is a promise. A promise that a bank will pay.
A promise that a borrower will repay. A promise that society will continue accepting this strange invention we call money tomorrow.
Money isn't merely something we own. Money is something we collectively agree to believe in. I am Lord TokenWire. Until next time, the news is real. The financier is not.